Hey, welcome back. It's Nolan Matthias, and it is clear that there's a large number of people out there that believe that the housing market crash is coming. If you just go and look in the comments of all of my videos, there's a pretty wide variety of comments there, and a lot of them seem to have to do with the fact that people believe that the market is going to crash. And there's all kinds of theories for it. There's people who think it's going to be because of interest rates or because of foreclosures or all sorts of reasons. And today I'm going to get into the coming market crash and what you should be doing to prepare. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell. Please hit that like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers, where one lucky subscriber is going to win $5,000 towards their TFSA or RRSP just for subscribing to this channel. That's right. All you have to do is click subscribe. It's free, it's easy, and it's definitely worth it. The definitive guide on how to manage your credit, product, penalty, price, in that order. It's never been more important to get your mortgage right. Okay, so let's jump into it and let's talk about the coming real estate crash, because there's a lot of people that tend to believe that the real estate market is going to crash. And there is a whole bunch of reasons that they believe it will. Everyone has their own justifications, their own rhyme, their own reasons. And if you just go and look through the comments of my previous videos, you will see that there are a lot of people who have a lot of different ideas with respect to when the real estate market is going to crash. You'll also see that there's a lot of people that believe that the market's going to continue to go up pretty much indefinitely. And whether you believe that the market is going to go up or you believe that it's going to crash, the one thing that is consistent amongst all people is that there's a ton of uncertainty. And what that means is that we shouldn't be just avoiding the news and avoiding the potential outcomes that are being predicted by different economists, but what we should be doing is making sure that we're prepared. And there's all these arguments for why housing could collapse. Inflation is the big one. People seem to think that there's going to be massive inflation, even though a lot of the economic stimulus that was put into the economy is just making up for the lack of economic growth that happened during the lockdowns back in 2020. And there's also a lot of people that believe that those same stimulus that were put into the economy is pretty much a guarantee that we are going to see higher interest rates. And well, that may be true. It also may not be true. And what I can tell you right now is if we see a very steep increase in interest rates, we are probably going to see a very steep increase in payments. And subsequently, we're probably going to see 3, 4, 5 years down the road, a pretty big impact on the real estate market. But the question is whether that will actually happen. And I just don't think that big increases in interest rates are in the cards anytime soon. The reason why I don't believe that is I look back to the 1930s out to basically the 1970s, where it took a very long time for us to climb out of a low interest rate environment. Then I look at the early 90s in Japan and out to basically now, where interest rates have basically been at zero for the last 25 years. And then I look at 2010 up until 2020, where it took 10 years basically for interest rates to climb from 1% to 3%. So I think when you get into really low interest rates, it takes you a very long time to climb out of it. So I don't think higher interest rates is a big risk. But there are other things that could come up as a big risk, right? It could be that jobs don't pick up the way we expect them to, or confidence is lost in the economy, and therefore people aren't able to make their payments, or they lose their jobs, and foreclosures happens. The one thing I think I can say with almost complete certainty is it isn't going to be the thing that anybody expects that will cause the real estate market to eventually crash if and when it does. And I'm not saying that I think it will. Again, I need to reiterate that I'm on the side of, I think we've got a pretty stable real estate market probably for the next 10 to 15 years. There's going to be ups and there's going to be downs. However, I do think it would be irresponsible for us to not prepare for the eventuality of some sort of market correction. So, there's a few things that I would look at. One is I'm going to look at affordability, and I'm going to look at sentiment in the market. And then I'm also going to look at how I can better prepare. And let me tell you exactly what I am doing right now in order to prepare for a potential real estate crash down the road. So the first thing that I will show you is I'm going to show you the RBC Housing Affordability Measure. This is the single best graph that I've ever found, or a single best piece of data I've ever found, to basically look at what affordability looks like, not only in the Canadian market, but in individual markets. We use this quite a bit for determining whether or not it's a good idea to invest in a real estate market from a long-term perspective. And when I look at this chart, there's a couple of things that stand out. First of all, there is the 1990s, where aggregate affordability, so the ownership cost as a percentage of household income, got up to about 56%. And then we saw a pretty steep drop off in prices. And then there's, of course, 2008, where we got up around 48%. Now, obviously, we know the reasons why the real estate market dropped off after 2007. However, that's one thing that I look at. And I look at this range between, for whatever reason, somewhere between 48.5 and 55% seems to be the maximum amount of ownership costs with respect to household median incomes that the economy can sustain. And then I get out and I look to July of 2017, and I see that that percentage ends up being about 50%. And it stays that way for basically the next 2 years. Seems to be fairly sustainable. We see the drop in April of 2020, which was when everybody pretty much went into lockdowns. And then we see it come back up recently to 50.3 again. Now, obviously, October of 2020, affordability rates are pretty similar to what they were in July of 2017. Obviously, housing prices have gone up, but the thing that has stayed the same is essentially the payments. And therefore, the payments are what drives affordability, not necessarily the value of the houses. And the reason why the payments have stayed the same is obviously because interest rates have gotten substantially lower. So I'm going to watch this number. And if I start to see this number peak up even further here in the next couple of months, and I see it get up to around 55%, I'm going to start to worry about the affordability of the Canadian real estate market. Now, the other thing I'm going to look at is I'm going to look at sentiment in the market. So this is the Nanos Future Value of Real Estate Survey. And, this is a really cool chart because you can see how people feel about the real estate economy. Here we are pre-pandemic, where people were feeling pretty good. Most people thought that the market was going to stay at about the same value or increase. Then we saw the lockdowns here, where about 45% of people, including Evan Siddall of CMHC, thought that the housing market was going to decrease in value. There was obviously a lot of fear in those couple of months. And then you see gradually over the last year, confidence has come back. Now, if the number of people who think that the housing market is going to decrease in value starts to go up substantially, or the number of people that think that it's going to increase in value starts to come down, that's where I'm going to start looking at the market and think, okay, perhaps there is something here with respect to a slowdown and a crash coming. And that's when I'm going to know that I absolutely need to be ready. So those are the two criteria I look at. I look at data and I look at sentiment. And if I'm looking at those two things and things start to change drastically in either of those two indicators, then I'm going to start to basically worry about the economy and therefore start to think that a real estate market crash is something I actually need to be prepared for right now. Now, as far as what I'm going to do, and these are things that I'm doing right now personally in order to prepare for the potential market crash. And I'm not preparing for it because I think that it's going to happen. I'm preparing for it because while things are good, it is the best time to prepare for it. And I also can't ignore the fact that a lot of people think that it's going to happen. So therefore, the fact that it is a topic of conversation and it is on the forefront of people's minds leads me to realize that I need to be prepared. And I think that you should be prepared as well. So here's what I think people should be doing with respect to preparing for a potential real estate crash. First and foremost, get your mortgage right. If you already have a mortgage, awesome. When it comes up for renewal, do exactly what I'm going to talk about here. And that is to make sure that you have the right type of mortgage that can withstand a downfall in the market. And the best type of mortgage for that is a variable rate. Not because it's better for interest rates, although it typically is, but because one of the things that happens when market values go down is people who have 5-year fixed mortgages who have to sell. And remember, if the housing prices have crashed, the rest of the economy is likely not doing well either, and that means there's probably job losses, and that means there's probably going to be the potential that people need to sell. Well, the people who have 5-year fixed mortgages tend to have an issue selling because not only have they lost their equity, but now they've got a penalty that they've got to tag onto the mortgage on top of that, and that subsequently creates an issue where they aren't able to sell, they're underwater, and then they've got to negotiate with the bank to see if the bank will let them out of the mortgage, or they have to declare bankruptcy. So the biggest thing with respect to mortgages is making sure that you have a variable rate so that when you do go to sell, you aren't giving a bunch of the equity back to the bank, or you aren't having to pay a big penalty or negotiate with the bank on a big penalty. You can more easily get out of the mortgage and therefore not have to do something like a consumer proposal, a bankruptcy, or a foreclosure. So that's the first thing I would do. By the way, I think that I would love to see the stat on this. I would love to find out how to get it. But my guess is that more people who have 5-year fixed mortgages go into foreclosure than people who had variables. And I think a lot of that is probably to do with the penalty and the inability to sell before actually going into foreclosure. Next thing to do is reassess your finances. Now, we all had this gift last year in March and April of last year where we had the obligation to reassess our finances because we didn't know if we were going to be working. We didn't know what was going to happen in the economy. So pretty much everybody, we ground to a halt with respect to our spending. We weren't going out and eating. We weren't doing things that cost, money that we normally wouldn't, that we would normally spend. And it was an absolute gift that we all got to reset our finances. And what I would recommend going forward is every March, April going forward, do a financial reset. Go, do I really need to be spending this money? Where am I spending my money? Is it more or less than last year? Is it more or less than the previous month? And are those things I've been spending my money on a necessity? And what I would go and look at is I would look at subscriptions. A lot of people are leaving Netflix right now for whatever reason, because it seems like they are not giving the same sort of programming they did before, probably something pandemic related, and the fact that they weren't able to film for quite a while. But do you really need that Netflix subscription? Maybe Crave's your jam now, and you don't need that Netflix one, or you don't need them both. And then looking at things like, still going out and spending money on ordering food from restaurants. I know a lot of people want to support the restaurants and whatnot, but you also have to think about yourself and your finances when you're thinking about when you're buying that meal every single week, right? Then I would be getting rid of debt. And, that goes in line with reassessing finances. So figure out where you can save money and then apply it to debt. I can tell you right now, we have stopped using our credit cards as much as we did in the previous couple of years. We are in the process of paying off our car loans because, quite frankly, I think those are going to be the single biggest obstacle to getting through any sort of future financial mess, is having a car payment. I would much rather today have a $10,000 to $15,000 car with zero payment than a $50,000 car that has a warranty and a car payment. This is probably one of the first times in my life where I have let a vehicle. I drive a Ford F-150 truck. It's a beautiful truck. It's now 4 years old. It's tipped over 100,000 kilometers, and it now no longer has a warranty. Normally, I would be rebuying a new vehicle, spending an extra $30,000 to $40,000 and getting a loan in order to have a vehicle with a warranty. Not doing that this time around, because right now I'd rather have zero car loan, a vehicle that I know, and one that ultimately, if I have no payments on, I can weather basically any sort of mechanical malfunction. But that's the key thing that I'm doing right now is we're trying to get rid of all payment obligations outside of a mortgage. I'm not going to try to be Dave Ramsey to you, but I'm going to tell you right now that the single biggest risk that people have is they're outside of mortgage debt when it comes to their finances and a potential real estate crash. The fourth thing we're going to do is we're going to make sure that we're staying in the game. The stock market's run up. Yes, the real estate market's gone up. We aren't going to pull our money out, because if they continue to go up, we'd lose any opportunity to realize on the gains. But what we are going to do is we're going to make sure we're not putting all of our eggs in one basket. So I'm not putting all my money in Bitcoin. I'm not putting it all in Tesla. I've got a little bit in each. I'm not going to put it all in real estate. We have a couple rental properties. We just bought another one back in October because it was a really good deal. But I'm making sure that all of our eggs are spread out. And we're also keeping a pretty big percentage of our net worth in cash. The reason why is because if the market does crash, either real estate or stocks, we want to be able to re-enter the market really quickly and scoop up the deals. And that comes to our next step that we're taking right now, and that is building up a reserve fund. So we're spending less, we're getting rid of debt. As we're getting rid of debt and car loans, we're taking that $1,000 a month in payments between our two car loans. We're going to use that to build up a reserve fund. And that reserve fund is there for two reasons. One is for the eventuality that there is a real estate or a stock market crash. And two is if there is one, so we can go and buy in when the prices are really, really low. So building up those reserves, still investing and still continuing to contribute to our RSPs and our TFSAs and buy more real estate as it becomes available. But we want to make sure we've got those reserves of cash for the just in case moment where and I don't think it's going to happen, but when the market crashes. And then the last thing we're doing is we're starting a side hustle. We've got several side hustles. We own our own business, so obviously our side hustle became our main hustle. But we have seen people in this economy do things like start sourdough instructional channels. I kid you not, I know somebody who started a channel on how to make sourdough bread back at the beginning of the pandemic, who is now making $300,000 a year. I know somebody in the beauty industry who is teaching people how to do aesthetics for women and build their own businesses, who's making over $6 million a year in that industry. And all they're doing is teaching skills that they had. And they both started in a place where they were doing something in addition to their main jobs. So what kind of things can you do to start a side hustle? Could you go and maybe do some graphic design work on the side or some writing on the side through a place like Fiverr or Upwork? Could you perhaps go and do lawn work for somebody and make a little bit of extra income? What are the things that you could do in order to increase your income and build up your financial reserves? Because the key thing to withstanding any sort of real estate crash, the key thing to withstanding any sort of issues in the economy is, one, making sure that you have little risk. Debt is risk, so getting rid of as much debt as you possibly can means you have less risk. And then the more reserves you have, the better. And the fastest and easiest way you have to make reserves is to make them while the economy is good and while you have the ability to put more money away and you're not worried about the things that jumped up and kicked you in the side of the head, like a stock market that went down in value or a real estate market that went down in value. So I don't think a real estate market crash is coming. However, I do think everyone should prepare all the time, not just in good times, but in bad times, for the potential crash in whatever you're investing in and whatever markets would affect you. If you found this video useful, do me that favor, hit that subscribe button, hit that notification bell. Please hit that like button so more people like you can see this video. If you would like to learn more about how to get the lowest interest rate, go ahead and sign up for our course. There will be a discount coupon in the description below, along with a link on how to get the lowest interest rate, secrets to getting the lowest interest rate. That course is priced so low that if you don't get 10 to 50 times the value out of it in return, just by knowing how to negotiate with your bank, negotiate with a broker, and how to get the lowest interest rate, I would be highly, highly surprised. We've also got our first-time homebuyers course, which I probably shouldn't let anybody else into right now, but if you're watching this video and you watched it all the way to the end, kudos to you. Link in the description below. I'm going to hold it open for another day or two. So again, if you found this video useful, hit that subscribe button. Don't forget about our race to 25,000 subscribers, and we'll see you on the next one. Cheers.